Welcome to the Naavik Gaming podcast, where it is our mission to explore the business and future of video games. We bring together the industry's brightest builders, investors, and thinkers to keep a pulse on current events, dissect emerging trends in games, share lessons learned, and have a great time. This podcast is also part of Naavik's growing ecosystem, which ranges from free and premium research to consulting and advisory services. For more information, visit www.naavik.co. This episode is brought to you by Overwolf. With over 1,500 games supported, 165,000 creators, and 38 million monthly active users, Overwolf is the guild for in-game creators. Whether you're a gamer, creator, or game studio, Overwolf is the ultimate destination for integrating UGC in games. For game studios, Overwolf offers CurseForge for studios, a white label solution that lets game makers and publishers easily integrate mods safely and seamlessly into their games, both existing and new, at zero cost. It's battle-tested by AAA studios and games, including Maxis with The Sims 4, Studio Wildcard with Ark, Take-Two Interactive, and others. For creators, Overwolf is the all-in-one platform that enables creators to build, distribute, and monetize in-game apps, mods, and game servers. In 2022, Overwolf paid over $160 million to in-game creators, proving that they truly value the talents and contributions of the gaming community. You can check out everything Overwolf has to offer at overwolf.com or check out the details in the show notes. And with that, let's jump into the episode.
Hello, and welcome to the Naavik Gaming podcast. I'm your host, Niko Vuori. I always say we have a special episode, and they always are special. But today is really special because this is our first emergency podcast here at the Naavik Gaming podcast. We are responding to the news that the SEC is going after OpenSea, the NFT marketplace, the leader in that space, and is calling NFTs potentially securities, which is a very big deal and has fairly major implications for the entire Web3 space if it actually files an action. It has filed a Wells notice, and a Wells notice is essentially a warning that the SEC is looking into you, but about 70 to 80% of Wells notices result in regulatory action. So this is not a minor thing. This is actually a pretty big deal. So we wanted to get together some folks who know the space, who've been covering Web3 for a really long time, understand NFTs, have worked in them. I actually produce collections and analyze the space for years now. So I wanted to introduce Devin Becker, who's the Naavik Web3 gaming analyst. He's been covering the space for as long as it's been around. And Stephen Wade, who is the founder and CEO of Midnight. He's been on the pod before with me, and he works in Web3 with a very real business with very real revenues and very real funding. So we collectively, hopefully, have a pretty good grasp on what's going on. We are not lawyers. So up the top of our podcast here, we're going to say we're not lawyers. This is not legal opinion, but we are going to do our best to unpackage what's going on in the space right now. What is the SEC doing? What are the implications for OpenSea and other marketplaces, NFT marketplaces like Magic Eden or Blur? And of course, more broadly, what does it mean for Web3 and Web3 gaming in particular? So with that out of the way, let's get right into the episode. Devin, welcome.
Always a pleasure, Niko. Always.
Steve, welcome.
Yeah, really good to be here. I like being the first emergency.
Yes, first emergency.
On your contact list. Yeah.
There you go. Yes, I'm going to put you into my my speed dial here. Okay, so why don't we start from the very top? So I'm going to start with Devin here. So Devin, what is going on here? What is the SEC doing? What is the SEC charging OpenSea with? What is a Wells notice?
So I think the important thing to understand is that we didn't actually get to see the Wells notice, right? So this was basically a tweet that came out from someone at OpenSea announcing that they received a Wells notice. And the way that they specified it was that basically they're being targeted for potentially like their marketplace having NFTs that could be construed as securities. One important clarification, I think, on that, just to be like to set the place for this conversation, is that I don't think they were necessarily saying all NFTs or NFTs broadly, but the NFTs on OpenSea or at least some subset of them. And I think that's going to be an important nuance. But because we didn't see the Wells notice, all we have to go off of is pretty much what we heard back. I believe they can probably share the Wells notice, is my understanding. It's not a private matter. And in fact, some public companies have to, but I believe this is something where they definitely could share it. And I hope we get to see the full thing. But basically, it's like, this is okay, we're going to do this. We're investigating you. Now, this actually starts a process where they could basically send something back to the SEC, called a Wells submission, that then is basically their sort of like appeal to it, and sometimes that just leads into settlements, which is like, that's part of like almost the negotiation, but it's kind of a one-time, like, and this is my understanding, of course, I'm not a lawyer, but basically they send it back and then they could consider that. And maybe they could consider, okay, maybe we want to investigate you because you explained yourself and we understand your position. But that is sort of their next step, is to be able to communicate formally through a Wells submission. So we'll see if they do that. They said they're going to fight it. So
yeah, I think it's important to note that 70 to 80% of Wells notices result in action, in actual formal charges. So it's not, it's likelier than not that this is going to lead to something fairly major. And of course, because OpenSea is such a big player in this space, it is the largest NFT marketplace still by trading volume, and has obviously ungodly amounts of funding and valued at very significant, multi-billion-dollar valuations. It is unlikely that the SEC would file this Wells notice and then pull it back. Hey, JK, just kidding. So this is probably going to lead to enforcement action. Obviously, we don't have a crystal ball, but it's a pretty real deal. So Steve, they're basically saying some NFTs, or maybe all of the NFTs, we don't know exactly because we don't have the Wells notice, as Devin said, are securities. So I think it's important to set the tone here. Like, what actually is a security? I know you're not a securities lawyer. None of us are lawyers of any kind, quite frankly. But let's look at what a security is. I think there is a formal definition, and I think we should understand what the SEC means when it's calling NFTs potential securities.
That's right. I'll try to use my investment banking background. But yeah, the Wells notice primarily is saying, well, again, we don't have their charges, but that these NFTs are financial assets. They're generally considered investments because there's expecting profit. I think profit is the key word. There's various other things that we look for. How easy it is to trade NFTs, the utility of the NFT. Is there a fixed value or not a fixed value? And if there's ongoing sales of those NFT, I think those would be some things that we would look at. But the relevance in the sex case, to Brian's point, we don't know what they're saying, and we don't know if it's the platform itself. So we don't know if it's individual entities that didn't pass. But there is a thing called a Howey test, right? So it's investments of money. So NFTs do involve buyers investing money. In a lot of cases, in OpenSea, Blur, Magic Eden, there is expectation of profit for these NFTs. And I think the frequency of which they are traded and tied to the platform is probably going to be an issue.
Yeah,
guys.
Yeah, I think that's right. And you mentioned the Howey test there. So the Howey test is essentially a four-pronged test that the SEC considers. It's been around since, I think, 1934. So a very long time. Definitely predates the internet, predates JPEGs of monkeys trading for hundreds of thousands of dollars, that's for sure. So TBD how relevant it is, but that is the test that the SEC uses. And the four prongs of the Howey test to determine if something is a security are: is there an investment of money? Is there an expectation of profit? And this is the one, by the way, this is the one prong that most of the cases, when they apply the Howey test, this is where most companies who are falling on the foul side of this, that's where they usually fail. It's on the expectation of profit piece. So that's important to know. And number three, is it a common enterprise? So in a company, that's very obvious, like the company's working towards a common goal of producing profits. And if you're investing in the company and a security in the company, that's pretty obvious what that means. It's less obvious here. Again, not a lawyer, but I think that's important to note. And then number four, is there a reliance on the efforts of others? So you are putting in money with an expectation of profit into a common enterprise that other people professionally are managing. You're relying on their efforts for that profit. So those are the four prongs of the test, and that is the very basic level kind of understanding that I think we need here. Obviously, there's a ton of nuance around all of those. And so it'll be interesting to see on the Howey test, because usually when you actually have one of these actions that the SEC is taking, you actually have them going through the four-pronged Howey test, and they actually lay out, like, here's why you are failing, or here's why we think that you are a security. based on the Howey test. So that's kind of the level setting here. Devin, back to you. So the SEC obviously has a checkered history of going after securities, and it has a mixed history, as in it's not always clear why they're going after some companies and others in the Web3 space. Does the SEC actually have a history of going after NFTs specifically? Obviously, they've gone after exchanges like Kraken and that type of thing. But have they actually gone after NFTs?
Yeah, there's three cases that I think are the most relevant. First one I'd actually say is Coinbase, because this is really almost like a sequel to that. And I think their victory there is what led them to this point. Although I imagine there was a bunch of other time where they were spent, collecting evidence, looking for gotchas that they felt confident enough going to this, because they have had some losses and they're trying to make sure they have mostly wins. And then the other ones is there's two NFT related specific cases around impact theories and Cool Cats NFTs that
Stoner Cats
fail for different reasons. Stoner Cats, yeah.
Stoner Cats.
Cool Cats was a different one. All these cats.
Cool Cats, there's a lot of cats. There's a lot of monkeys. There's a lot of apes.
I feel like Cool Cats had its own thing too. I don't know, but yeah, these cats. The Stoner Cats are the less cool cats because they're just stoned, I guess. But unfortunately, yeah, they both resulted in like settlements and sort of judgments against them, as did Coinbase for the most part. There was a very small exception there, but for the most part, Coinbase also got hit with it. And that's the big thing here is all these pretty much set this up right now. It was basically Coinbase was it acting in a similar sense where they were facilitating the same sort of thing, but with tokens. And now because they didn't, that's why I don't think this is about all NFTs, because that wasn't about all tokens. It was about the tokens they consider to be like securities. And therefore Coinbase was facilitating that. And they're looking, I imagine, at OpenSea the same way. You guys are facilitating some of these that we consider securities. You guys are making profit off that. You guys are running this as a business or a broker or whatever the legal specific pigeonhole they put them in as. But I think that's really where it's going, is that case again, but combined with what they pulled off from the Stoner Cats and the impact theory one, where they kind of found like the other parts of the Howey test that you're talking about around the expectation of profits, the promotions, and I think a lot of it really was more about the utility aspect of it, which is like if they're promoting this as like a business or a common enterprise kind of investment, as opposed to something where it's like, oh, this, you buy this, but you could also sell it too. That's not quite the same thing. And I think that's where this is going to lean towards. So I think looking at the Coinbase one, because there was some great detail in there that the judges, came up with, as well as SEC. And I think I kind of agree with some of them, as much as I hate to side with the SEC, but I think it was worth looking at the details, like the actual quotes of what they said, like they supported for the SEC, how they were rebuffing Coinbase was like super specific about like what they were doing specifically. And I think same with the other two cases, where basically you had the judges like laying out why these are failing the Howey test. And then that was even more interesting, because you had dissenting judges on both cases to actually say like, this is where we think this might be a slippery slope. This is where we think the SEC, the main argument was just basically that they are being too selective potentially. And I think that is probably true.
Yeah. Interesting. I think the impact theory and Stoner Cats both resulted in settlements. I think Stoner Cats, they agreed to pay a $1 million fine and then to cease and desist. But what's interesting about those is that those were settlements and were not appealed. And none of these have actually been appealed yet, right? Like there is an argument to be made that you could appeal these if you wanted to go up against the SEC. So what is the counter argument then, Steve? What is so Devin Dinser, who's the founder and CEO of OpenSea, he put out a response on X, Twitter, and he basically defends NFTs as essentially art, art collectibles. What's the counter argument to the SEC here? Why should we not consider NFTs as security?
In the blog post from OpenSea and then the X or the Twitter reply, I think they're trying to combine the art and the NFT technology, right? I think that maybe a bit of a smokescreen there, because I think the underlying art is still art, right? And I think what they're trying to lead into is the creator economy, allowing artists to essentially, profit, make a living from this. But the lines are definitely blurred. Like there's a gray area. And I think the gray area is the counter argument. I don't think you can, with certainty say that, hey, NFTs are art, they're not securities. I think it's a bit blurred. The fact that we don't have regulation from the SEC, I think there's a lot of things. It's kind of like we're doing the best we can. Even at midnight, we have multiple legal teams involved around the world to make sure that we're as compliant as we can for the SEC's regulations of the day. So I think that, the best case would be, it's like, hopefully not every NFT project is looked at security. To Brian's point, it's probably just a few bad actors in the group that, it's like this gotcha moments. But I would say that the best argument is it's a gray area. People are trying to be as compliant as they can in the current regulatory environment we have.
I looked at Devin Dinser's post, and I know that Devin Becker, I know you're specifically saying that it looks like it might just be certain, specific NFTs. Steve, you're mentioning it might be a certain bad actors. Devin is certainly painting it with a fairly broad brush. I know it, behooves him to do so, I suppose, because, he's talking on behalf of all the creatives, all the creators of NFTs on his marketplace. But let me just read out a quote from his, it's longer and you can go check it out online, of course, and search for it. But this is kind of the money quote in my mind. So I'm just going to read it out here. It's a few sentences long. "This is a move into uncharted territory. By targeting NFTs, the SEC would stifle innovation on an even broader scale. Hundreds of thousands of online artists and creatives are at risk, and many do not have the resources to defend themselves. NFTs are fundamentally creative goods: art, collectibles, video game items, we'll get to that in a second, domain names, event tickets, and more," end quote. And then he also pledged $5 million to help cover legal fees for NFT creators who might also be getting these Wells notices. So that's what he's saying, that it seems like the SEC is coming after all the NFTs, and anything is fair game. Video game items, Web3 games. Steve, obviously, you're in that space. Yes, it behooves Devin to paint it with a broad brush. But Devin Becker, are you saying that it's actually more nuanced than that?
Yeah, I mean, I don't necessarily have anything fully against OpenSea. They've made some bad decisions over time, but this feels a little bit like trying to use the baby in the crowd to shield yourself by trying to
talk about the analogy
appeal,
there.
Right? We're trying to appeal to everyone's sympathy, right? And I think at the end of the day, like, I honestly think it's just going to result in a settlement where they basically just have to delist a certain number of them and have to be stricter about what they accept and how they market them and all that stuff. But I think the example that was actually kind of made in the Coinbase case around Beanie Babies and is trying to be trotted out again around collectibles, I think is a great example. If the Pokemon company came out and said, buy Pokemon cards because you can make a profit from making Pokemon cards more popular and then selling them on the secondary market, and that's the main use of these, you don't actually need to play the game, just flip these on the market, they would be slapped down, and rightly so. That's really the defense. That's the hard part to justify. If you were saying this is art, well, then it needs to stand alone as art. It doesn't need to be a profit-seeking enterprise. There doesn't need to be this whole thing built around it. Now, when I went to OpenSea earlier, like, the first thing I see on the page, floor prices, market volume. I'm sorry, but it looks like stock tickers to me. Like, at the end of the day, like, it's hard to make that case. And I love NFTs. I think they're fantastic. That's what really got me into Web3, especially around games. But you need to market them as NFTs and not as securities if you don't want to be treated as a security. Like, the Howey test, like, I know everyone says we have no guidance and stuff like that, but I think the guidance is really simple in the sense of, like, don't put it out there like it's a security, and there's less likely to come at you like it's a security. And I think the marketing angle has really been used against a lot of these companies. You look at the Stoner Cats one and the Impact Theory, that's exactly what they quoted their marketing, they use their marketing. And I imagine the reason this took a while to get to this point, both off of the back of the Coinbase as well as the previous ones, is them collecting all of that stuff to present that in court and go, look, you said this, you presented it this way, you set this up as essentially some kind of securities market rather than just an inventory of secondhand goods like Craigslist or something. And I think, like, this is not eBay. Like, eBay's not like, hey, buy stuff just to sell it on eBay for profit. And I think, like, Blur especially would be really guilty of this.
Yeah, counterpoint. Steve, I know you want to jump in there. Yeah, go for it. I mean, I'll do my counterpoint.
Oh, no, I just like the simplification, especially of using Pokemon cards. I think, any conversation, any podcast we're talking about Pokemon cards, it's going to be a good rest of the day. The art versus security, I don't think we're arguing, and it seems like we're all kind of in alignment. The art itself is, and the reply from OpenSea is a little misleading because it's not the art that the SEC is security. It's the underlying contracts. It's the speculative nature. It's the marketing, that brings scrutiny from the SEC. And so, with the analogy of Pokemon cards, I think what OpenSea does, like, hey, we can sell Pokemon cards. We can sell them on eBay. There's no issues. But if we have to, attach a golden frame, they have to be sold with this golden frame, and the golden frame is what's going to drive value up. I think that's
you mean
that's the
grading
issue.
cards basically,
Exactly,
like they did during COVID.
Yeah,
Mm-hmm.
that's right. Oh, there is I don't want to get too far off topic, but there's a service now for $100 where you can send a pack of unopened cards, and they X-ray it, and they'll tell you all the cards in it. I'm like, oh, it's just ruined it for me.
Oh, there's a service for everything. I'm going to throw my counterpoint in here, which is just because you market something as like, hey, you could make money off this, that doesn't make it a security, right? Again, I'm not a lawyer, so I'm not going to, opine on the Howey test here or how exactly Stoner Cats marketed their NFTs. But I mean, fine art has been traded. Fine wine has been traded for the longest time as something that will potentially appreciate in value. And we have had art markets long before the SEC existed, and they've never gone after them either. We don't have a lot of legal opinion in this, so I'm just going to read one opinion piece. This is one guy that I've vetted for a grand total of 15 minutes, but he is a law professor called Brian L. Frye, Frye. He is himself an NFT artist. He's put out collections. He's actually sued the SEC prior to this because he wanted to get a no action from the SEC for this entire space. He's not been successful so far, obviously. But he authored an op-ed piece in CoinDesk just this morning. It literally published like less than an hour ago. And he says that the SEC wanting to regulate NFTs exposes the incoherence of the SEC's understanding of what it's authorized to regulate. And then he continues, the SEC is wrong. No, it's worse. The SEC is nuts. Now, I'm going to pause here and editorialize a little bit. Rarely does it behoove your point to call somebody nuts. But anyway, be that as it may, he continues. The NFT market is identical to the art market. Or rather, the NFT market is an art market. If the SEC can regulate the NFT market, then it can also regulate the art market. But the art market existed long before the SEC was created in 1934, and the SEC has never regulated the art market or even contemplated regulating the art market. It can't and it shouldn't, end quote. So that is but one law professor's opinion, but it is a law professor who is steeped in securities law and on NFTs. He has his own collections. Kudos to him for putting it out there. By the way, one of his NFTs was a redacted legal filing, where he issued his laws. I don't know if you guys saw that, but it's really funny.
Yeah, I now remember this guy.
Yeah, so he's he puts his money where his mouth is. Let's put it that way. So Steve, like that's the counterpoint there. Like it's an art market. It's nothing different than like a Sotheby's or Christie's auction house. Like, we've always invested. We use the term invest. I'm investing in art. I'm diversifying my portfolio. I'm getting into fine wines. Like, hey, like surely NFTs can be treated the same way. Surely.
The first thing that comes to mind is, art.com, one of the tech bubble losers, where essentially, if you guys remember art.com, but it was some artist, I can't remember his name, but he had shops in all malls across America, and it's like, you buy this art and it's always going to go up in value, right? And obviously tanked. But the art market to the NFT market, I don't think I don't think it's one for one, right? So you take a Rembrandt or you take your rare graded Charizard card, right? Not a security, right? Because it's art card. You can divide that Rembrandt or that Pokemon card into 1,000 pieces, and then sell ownership of those pieces to people. Then it's still not security. But if you say, well, now that ownership is connected with the business, where by distributing those art pieces, we're going to fund a business. Now that you're security, right? So I could take that Rembrandt, that Pokemon card, cut it up, trade it. It's just NFTs, no issues. But the time where you're making future promises where the value is going to go up, and you need the money to build a studio. There's a lot of companies, Magic Eden, Blur, OpenSea, they'll launch NFT projects first to fund their games, which makes it a security. So I think there is some issues there. It's with what point do you go from I'm selling art to fund my lifestyle to now this art is funding a business, and you're expecting the value of the art that you're buying to increase. Yeah,
and I think that's the point there. It's a fine line. Again, I'm going to
back to blurred areas.
I'm going to keep taking this position here because apparently I'm the only one on this side in this conversation here. But
I thought I was going to play devil's advocate.
I know.
I'm on the side of just behave, okay? Just behave.
Yes. Oh, certainly they're a bad. Here's the thing: like nobody disagrees that there are bad actors in the Web3 space, right? Like
Sure.
we would be the first ones to admit, like it is full of crypto scams and pump and dumps and like buy this and it'll go up in value forever. Those should be flushed out for sure.
Sure.
But I would argue that the majority, I don't know if it's the vast majority, but the majority of NFT projects, whether they be games or pure art or, Beeple selling his, early thing for 60 something $million or
I remember
whatever.
that,
That there may be an expectation that goes up in value, but that does not make it a security in and of itself, right? Yes, if you market it like, hey, invest in this and you're a part owner in this company or in this DAO, decentralized autonomous organization, and you will have, voting rights and ownership. Like, yes, that is quite clearly a security, right? That is quite clearly a security. But I think since the early days, like most NFT projects have tried to avoid that, like the plague, right? And if anybody, I worked at Web3 and we consulted with lawyers. Steve, you have 6 different law firms representing you. And I had really hoped that you would be able to talk to at least one of them before this podcast, but you haven't yet. But nonetheless, most NFT projects that are legit and are trying to do something interesting with this new technology, which is blockchain technology, which allows ownership and allows for interesting things to be done, interesting new game designs or interesting new business models. That does not make it a security in and of itself. It is a piece of digital art or piece of digital video game asset. And if you own it and it happens to go up in price and you're even hoping it goes up in price, that doesn't make it a security. So I'm gonna stick to that point here. So Devin, counterpoint back. Like we could go back and forth on this a long time.
Yeah, absolutely.
And we're not lawyers, but it feels so cut and dry that the SEC would be going after like NFT. Like we also agreed that like tokens and fungible tokens, right? Fungible tokens, there's a difference, right? Fungible tokens purely is there for making money. Like it has no other purpose other than speculation, right? Tokens, pump and dumps, what have you. But NFTs are, if you take it at face value, are pieces of digital ownership. Like they are unique in the sense that they can be tracked to the blockchain and their provenance can be confirmed, just like we track provenance with.
But you don't get profit sharing from the Pokemon company for owning that Charizard.
Yes, but not all NFTs give you like if you're staking them, for example, like the whole staking mechanism. Yes, I'm 100% in agreement. Like when you're staking NFTs for an expectation of like some return in fungible tokens or like extra ownership or what. Yes, that is quite blatantly a security. But I would argue the majority are not doing that.
I would absolutely agree that fundamentally NFTs are not a security.
Right, fundamentally,
but they absolutely can be. In my experience in doing a lot of consulting with a lot of different companies is everyone's trying to tiptoe up to that line. And the complaint about SEC guidance so much isn't necessarily about guidance. It's about where's that line so we can tiptoe right up to it.
That's right.
Because we need to know where it's at. Because if we're just kind of like not sure where that's at, we might accidentally cross a toe over it. And then you could come after us, partially because that's selective enforcement. But I think the area to focus on, and one of the dissenting judges pointed this out, is the risk of slippery slope towards fundraising as a crowdfunding. So meaning like if you were to take Kickstarter projects and approach it the same way a lot of these NFT projects were to, it'd be very obvious that you're engaging in securities fraud, right? But because we have all this technology and we're building the future, and I'm a huge futurist. So I'm like, please do whatever you want. I don't care, break the law, just go crazy. But at the same time, you do got to realize like people are going to come after you. So that's where the area gets tricky. And we have all these terms like aligning incentives and all that stuff, but really you're just kind of double speaking around securities fraud to some extent. When you're talking about incentive alignments, you're basically saying, hey, you're going to be a shareholder, sort of, which is very clearly, securities. And that's why I say the way they talk about it is important, because they're framing the expectations. And a lot of the Howey test is about expectations. And it's about expectations for something that you don't control. And I think that's the reason that it's kind of treated as investment contracts and that sort of thing is you're not investing in your own business. You're investing in someone else's business. I think if it was your own business, then it's fine. You're investing in your business. Like that's a normal thing to do. That's not a security. But because it's a common enterprise where someone else is responsible, you're investing in someone else's business, essentially, or a bigger business or a common business. And in doing so, there should be protections attached because it's not your business. You don't control it. So that's the SEC's job to say, hey, people are investing in things they don't control. We should protect them from investing in the wrong things and fraud. Now, do they go wrong and go in wrong directions and use selective enforcement? Yeah, all government agencies do. Like, it sucks and I hate it. But here we are. needing to be a little more careful in how we present things. And like, again, Kickstarter is a great example. If you were to figure out where those lines are in Kickstarter, I think it becomes very obvious, very quick, what makes sense for crowdfunding or not, or what makes sense for shareholder type investments or not. And I think investors being involved really helps muddy the water, because you're talking about, especially around tokens, things like staking, like a lot of that stuff, investors really skew towards looking at ways where it starts becoming securities. And they're really, the VCs are often, trying to tiptoe up to that line. I think even more than game developers are. And game developers are just like, dude, I need money to make a game. What do you want me to do? Okay, I'll do that. And it's like, again, like Kickstarter, where Kickstarter is a little more transparent and clear. You're basically buying a product early and you're getting a discount for that. And that's helping fund the thing. And it's very clear. It's not some expectation. You're not expecting like, hey, I'm buying this Kickstarter thing so that I can flip it later. And then other people will flip it and the profit will go up forever and I'll get royalties or whatever. Like that's, I think if you present it in arguments that are not like sort of like swimming in technology, and we just talk about Kickstarter or Pokemon cards, and you start like taking analogies that aren't perfect analogies, but it starts making it a little more obvious why maybe like don't go that direction so much. If we want to push this technology forward from an honest perspective, you're saying most projects are like an honest side. Well, it's like, well, let's keep them like that. And then they probably won't be targeted. I'm not the whole, like, if you're innocent, everything's fine. Obviously that's not true all the time. But I think in this case, they can only prosecute so many cases. They're just trying to make examples. Don't be one of those examples. Try and focus on the technology and doing like the Kickstarter kind of stuff where you're like, hey, we're trying to build a common game together, but it's not a financialized enterprise. It's a game or an art project. You don't see people pitching, I'm going to make a bunch of art as a project for financing this whole thing and like all that. Yeah, maybe Banksy does some weird stuff like that, but overall, you don't see like Sotheby's trading in art that's the same kind of concept as OpenSea and NFTs or Coinbase and crypto, partially because we like to pretend art isn't that. We're like, oh, we buy it to look at it. Obviously, like, I mean, obviously there's a little bit of deception in there, but it's all one we've kind of agreed to at this point and just kind of accept. And I think maybe NFTs get to that point.
Mm-hmm. Okay. All right. Well, I believe we have staked our positions, our non-legalese positions. So let's shift over now for the rest of the pod to talk a little bit more about what this means for Web3 and gaming in particular. Again, I called out Devin Dinser's quote there where, he calls out art, collectibles, video game items, domain names, event tickets, and more. So video game items, of course, there's a massive industry, at least in terms of VC dollars, yet to be proven in terms of obviously many sustainable businesses, Web3 gaming. But many business models and many interesting things are going on there. Steve, as somebody who works in Web3 and incorporates NFTs in your products and your games, what do you think this means for developers? Are you worried about this? Is this something that...
I think it means less for developers than it does for the projects just, flipping art NFTs. Because as we chatted about, like, the profit and then also the use of proceeds. I think, Devin's Kickstarter analogy is perfect for that, right? If it's NFTs where, some creators promise future benefits and so utilities, I could see where it gets slippery slope, but if you're essentially not distributing any profits, right? Essentially people are donating or buying stuff for you to build a certain thing. I think that's a little safer, right? I don't think there's been issues with Kickstarter and people pre-purchasing items, to essentially build that game. But games themselves, I mean, we've been kind of dealing with remote money transactions for a while. At least all the companies I deal with in the US are taking things fairly serious. They're focused on utility of that token inside of an ecosystem. I think, that's, one of the larger key areas. Everyone always talks about utility. What does that actually mean for games? And the companies that focus for real use cases for the NFT, for the token inside of an ecosystem. I don't think the game companies are going to be that affected, right? Because they've already thought out, most things, the use of proceeds, the profit. It is all focused on the game studio themselves. Some go a little farther and try to do the decentralized stuff and, Wyoming and offshore foundations. I think if everyone's doing that together, it's going to be, to Devin's part, it's going to be hard for the SEC to sue everyone. It's going to go after big players. You don't want to be one of the companies to get caught doing something wrong. so I'd say most of the game companies, I don't even know will be too affected by this, because they've already, at least all the ones that I worked with, have kind of been trying to find out where that line is, as Devin said, and walk up to it.
Yeah, I think so, and as did I when I was working in Web3. But counterpoint here, and again, I'm saying I believe this, but I'm going to do the counterpoint here, which is a very, very common model in Web3 gaming is to do a mint pre-game, right, pre-launch, and sometimes multiple mints, and that mint is essentially a kind of promise of future utility, which hint, hint, nudge, nudge, might mean that it trades for higher prices, on the secondary markets in the future, right? This is a super rare one. This is like your, golden sword that's going to beat everybody, all the monsters, right? So that is an expectation of profit, just no different to the art piece. And then many games, not all, but many games have fungible tokens as well as in-game currencies. Entire economies built on top of crypto and fungible tokens, which again, trade on secondary markets, which there is an expectation of profit. It's a common enterprise. We're building a game together. I own this asset. I'm part of this community. They talk a lot about community. Community is just another word for common enterprise. And you're relying, those investors, and they call themselves investors, who buy the NFTs and invest in the tokens in gaming companies or gaming studios, they are relying on the efforts of the game developers to build that studio up and make that game successful. Yes, of course, there are very altruistic versions of this and fully on chain stuff that's going on that's, good intentions. And I don't think any or most game developers don't go into Web3 thinking bad intentions. But there is absolutely the case to be made, and the SEC may very well make it, that these NFTs and fungible tokens that are part of, in-game economies are also securities. Now, we haven't seen that happen yet. And obviously, to everybody's point here, they can only do so many enforcement actions. So they're going to go after the exchanges first. That's where you start, right? Like the big boys, and then slap them down. And then there is that layer below. We saw it with the Stoner Cats and Impact Theory. They may very well make an example of something like, Axie Infinity, for example. I know from a couple of years ago from legal insiders that they were being looked at. They were being looked at by the SEC. And I would not be surprised if there's others that have had big splashy, economies and play to earn, in particular economies, where there's truly an expectation that this thing was going to go up. That's the whole point of playing. You're playing to earn. So that's the counterpoint I'm going to make there. Devin, your thoughts on that?
Yes, lots of thoughts. First, just quickly on the Axie thing, I think the Sky Mavis was good about promoting the fact that people just wanted to play a game first and foremost. And I think that was a good idea on their part. Not that they were necessarily right, otherwise everyone would still be playing it, but it was definitely a good way to be like, hey, no, people love this game. They're so excited they want to spend $1,000 on an Axie. That's how much they love this game, and everyone just loves Axies. They're so cute. And they want plushies of them and all that. So they've clearly managed to dodge that bullet to some extent. And I think even the play to earn thing, it's like you're doing something in theory of value to earn. It's not dependent on others in that sense of the common enterprise. So that's sort of like a little bit on the edge of the Howey test, I think, which I'm sure you can make the argument either way, but I think that's where they're like, hey, you're playing to do that earning. You are not earning just from having bought something.
So something we got a lot of feedback from our various law firms when it comes to NFTs. Midnight as a company, primary sale, we have fixed prices for any NFT we would sell. So if we as a company would sell something on Magic Eden or OpenSea, that was a key thing for us, is having a fixed price. Now on the secondary market, if it, people are speculating and it goes up and down, that's not on us, and I think that's key for game developers as well.
I think the art guys would argue the same thing. They would argue the same thing. Like we're going to mint this art out at a certain price. We'll charge whatever we think the market will bear. That's the logical thing to do, and then it's not up to them what happens on the secondary market, right? So I think the argument is exactly the same. Again, I'm playing devil's advocate here. I want to use these technologies for interesting things. I think that game developers in particular, near and dear to my heart, of course, we just want to use new technologies to do interesting new things, right? Create interesting new game economies, create digital ownership that, you can transfer from game to game or ecosystem to ecosystem. Like, that's what we want. We want to create exciting, interesting experiences for gamers, for our players, right? But the art guys are going to say exactly the same thing. They're going to be like, well, we minted it as everybody buys. Who's? It's not up to us. What happens in the secondary market? People are speculating on it. Like, cool. Like, they make some money, but all we get is that little secondary royalty, like 2%, 5%, whatever it is. So I don't know. I feel like, yes, I'm with you, and of course, Steve, you're you're in it, you're in the thick of it. So I understand your perspective here. But I'm just going to make the point here. Like, if the SEC can say that art projects and art NFT projects can be securities, can be treated as securities under the Howey test, then absolutely, video game, Web3 gaming, NFTs, and certainly the fungible token economies can be treated as securities as well. So that's my kind of point there.
The SEC doesn't care about interesting technology. They just care about, are you trying to make money with this whole thing in a way that could potentially be fraudulent and falls under their jurisdiction? Like, they obviously can make mistakes with that judgment, but that's basically what they're going after, is people that are trying to make money off. There's not people just doing interesting technology stuff. If that doesn't involve money, they don't care. They're not participating in that. It's just, if you're trying to make money off of it in a way that maybe is more blatantly falling under the Howey test and trying to set that sort of stuff up, then yeah, you're going to be setting up a situation where it's going to at least look like you could potentially be a fraudulent enterprise, or an enterprise where investors might need some protection. But again, I'm not arguing for the SEC because I don't think they necessarily do the best job, and I'm not a big fan of Gensler. With that being said, there is at least some reason why they win some of these cases, which is, if you're looking at it from a law perspective, this is about jurisdiction and whether or not it falls into them. And if it falls into the Howey test, then it falls into the jurisdiction. How they enforce that, what kind of fines, settlements, and all this stuff, that could be all over the place. But I think when we're talking about the Howey test and whether or not the SEC has a say, I think that's really what we're talking about, is like, are they checking those boxes, maybe knowingly or unknowingly, or are they just trying to do cool stuff? And if they're doing cool stuff, that's probably someone else's problem to come harass them and deal with that. Probably people that are anti-encryption and all the other fun things we have going on with government agencies that aren't the SEC. It's just the money part the SEC cares about.
Yeah. And then by definition, if you have an NFT in your game, it is a money part, to use your terminology.
It depends. If it's just secondary market, if you're just like the Valve example I was going to try and get it to, where if it's just CSGO skins, you're not investing in Valve to get CSGO skins to have those go up in profit. That being said, there is interesting dynamics with like pre-ordered items and that you could potentially sell. But you're not buying them for the expectation that you're buying them to have them in the game. And I think the game argument actually helps. Like, art is a little trickier because it's like, oh, I just look at it. But game objects, if there is a game utility, I think there's an argument to be made that people bought it for that reason and it went up in value because it was fun or useful in the game. That's different than buying it for the expectation of flipping it. If you're buying it for that, that's your own individual decision. But if the company's marketing it for that, that's the company's decision. That's where the SEC steps in. If I just want to flip stuff, if I want to flip Bill's hat, which I was tempted to do many times, I think I might have even meant for pre-ordering Left 4 Dead, I'm not sure, but that's a case where that's my individual decision. And yeah, sure, Valve does make a small marketplace fee off that, but they didn't promote it for that. They didn't set it up for that. Artifact maybe have been a little bit different argument there. They actually might have started treading towards SEC water in some ways, because unfortunately my cards are now worthless, and I would have loved for them to protect me as an investor in my Artifact card collection, because there's no interoperability, unfortunately. But that's, I think, the important distinction for games is, if you make just stuff that's useful and people could sell it on a secondary market, but people aren't buying it for the secondary market, or at least you're not promoting that as the main reason, I think you're probably okay. Where we get the Maple Story stuff could be a little interesting if you've seen some of the stuff that's come out about that. That's an interesting dynamic. I think they're probably fine. But South Korea did very recently, I think it was either last month or the month before, pass a thing saying NFTs could be considered securities. So they actually laid this line in the sand a bit more than Gensler did, but said, we will, if they act as securities, we will consider them on a case-by-case basis. So it wasn't like just everything's out there, but they work their government a bit differently like that. So.
Interesting. Okay. So Steve, you mentioned before we actually started the pod that you've got 6 different law firms that you work with. Tell me a little bit about what they have been telling you. You have presumably consulted with them, every step of the way as a responsible game developer in Web3, and with a long track record in there as well. Tell me a little bit about what they've told you. None of the three of us are legal experts. This is just armchair legalese. But your lawyers presumably know what they're talking about. So what have they told you with regards to what we're just kind of debating here, like NFTs inside games? If you sell them before the game launches, like, is that a crowdfunder with an expectation of profit? Therefore, that's a security. Or it's like, okay, if you just give it away for free, then clearly you're not making any money. And then if the secondary market does the trading, that's on them. That's, not your problem. There's so much gray area, so much nuance here. You've got 6 firms. You've been navigating the space for years now. What have they been telling you to stay clean and clear of the SEC?
Stay clean and compliant.
Yeah, safe and
law
compliant.
Firms, exactly. I think we're one of the only game companies that has Deloitte on their logo. So we our white paper. We took it fairly serious. Even so, we were doing tokens. Our token was delayed, but it's on its way. We looked at tokens and NFTs the same way. It's like, if there's an opportunity to be declared a security, we're going to expect it. So let's do everything in our power to make sure that it is not. And some of the themes that come back, utility is always at the top. I think with NFTs, like, you can expect things, right? NFTs are, I think, Devin, you mentioned the word interoperability a couple times. Like, people expect NFTs to flow and go here and there. We never want to market or promise anything other than what we can control, right? If we're making a game, it's going to do X, Y, and Z in those games, and it's good. Whereas, some of these projects, they kind of appear, and I think these fall into the bad actors where, like, we're making this opossum NFT collection, and it's it's going to be in Fortnite, it's going to be in a Marvel contest. Like, I think there's promises with some of these things that just they're not going to be able to live up to expectations, and so makes their utility kind of zero, and that, because I would say they're a security. But the no expectation of profit, I think, for us selling items to users, that's key. I think we've all agreed that people shouldn't be buying things just, it's individual, but us as a company, we're not going to say, like the art.com, like, you buy this, it's going to go up in value. We say, you sell this, you use it, it's going to be a lot of fun in our games because it's going to have X, Y, and Z utilities. Another thing that came up with law firms is always about transferability or limiting transferability. So if you have a project that's openly on OpenSea where people can just trade it all around, the ease of transferability actually makes things a little more in that gray area. So I think if you allowed, in our case, we do take things in the market, but we kind of want to have the Chuck E. Cheese model where you come to us, you buy your arcade, you buy your pizza, and you stay within the ecosystem. I think that's ideal. The markets where it's just, you're trading for the pure sake of trading, what we've seen is like the NFT and the game product, they don't correlate. Like, the value of the game is far less than the trading speculation on things. So the legal teams did make that a kind of a 0.3. 0.4, which we kind of talked about, was fixed value, right? If Midnight or Artist want to sell an item, we sell for a flat fee. We don't go to auction houses or something. We sell this item. Now, if it trades on a secondary, because that's what market conditions demand, the fluctuating nature, I think, could be seen as a security. But us as Midnight, we're not taking benefits for that. We don't have royalties on that, or we're not trading on our own NFTs. Essentially, once they're sold, they're users. Another issue, I think, particularly for NFTs, is there's always new ones coming, right? The same company can launch multiple projects, and that's okay. You're an artist, you're doing that. But just because they're being constantly created, sold, resold, the sellers are promising these are valuable assets, and then they create new ones. I think that was an issue that they wanted to look at. And then the use of proceeds we were chatting about, I think that's a big one, right? So Brian's Kickstarter analogy, I think, makes perfect sense because it's, people are essentially buying into this. They're not expecting to be distributed profits because we're building a platform. With NFTs, a lot of times it's just future benefits. There's no utility if you're, you have to use token sales to build something, or then you don't build it. kind of expectation of profits there.
Yeah, but that I mean, that's just plain fraud, right? Like, I think
just plain fraud. Yeah, okay.
You know,
a lot of Kickstarter things. They apparently
a lot of Kickstarter. Yeah, so I think we could all agree that the cases of plain fraud, you know, the pump and dumps are like, I'm going to go and build this cool thing, and then you know you just take the money and run, right? Like, that's not. I don't think any of us are talking about that and defending that. And I think there are very, very few people on the planet who would defend that kind of behavior. I mean,
can we have the SEC come after all these pre-order games that turn out to be crap?
Yeah, right. Exactly.
Please.
Yeah. So points taken, Steve. But I do. Yeah. I just want to call out like things that are obviously fraud. We should call them out as obviously fraud. And that's not what we're talking about. We're talking about the SEC coming after. I think they're going to sweep up. I don't know for a fact. Again, none of us know what's actually in the Wells notice. We don't know exactly which NFT projects, if you know any, they're specifically coming after. Is it all of them? I mean, Devin Dinser again seems to paint a very broad brush, and he's saying like, "Oh, it's all up for grabs now by the SEC." Taken with a pinch of salt. Okay, so I'm gonna shift gears now, and let's talk a little bit about So we've talked a little bit about what we think it's going to do for Web3 gaming. Steve, you think it's going to be okay. Devin, you seem to think it's okay. I'm a little more skeptical. Let's see what happens. But investors. Right. So indirectly Web3 gaming or Web3, you know, this entire ecosystem more broadly, it has relied heavily on investment in order to get projects to market. You know, Web3, I don't know what the latest numbers are, but, you know, Web3 investment, there has been billions and billions and tens of billions of dollars invested into Web3 gaming. TBD, what the return on that is going to be over the years. But, you know, nonetheless, a lot of money has gone in there. What do you think this is going to do to investors? Like, are they going to start to get a little like, ooh, I don't know what's going to happen here. Like, I'm going to pull back. My money's at risk.
Yeah. Well, I think that's already been happening, right? I think Web3 gaming has not had a lot of great returns. You know, with the first wave of companies that, you know, raised a couple of years ago, their games were a bit of a flop. Some companies that did well, like they had a token offering, and token offerings did quite well. They're seeing that even though they have a token that has decent value, the cost of operating games is quite expensive, and you know, so they're losing money on the game side, but they're making money on the token side, and so that's kind of awkward. But I still think that's a benefit to VCs. That a token, they would, you know, I think they would much rather invest. At least the ones I talk to, maybe I'm just in a bubble. But you know, I've been on the investment side, the VC side, for a couple large companies, a couple MMOs raised, you know, $1 billion in fundings. The company had done significant revenue, right? $1 billion in revenue for $1 billion in funding, but the investors saw zero, right? The company shut down because, you know, with things time, the you know, games lose their hype and their inflation. They can only run for maybe 7-8 years. Not everything lasts forever. All games die at some point. Had there been a token associated with those things, investors could have saw some liquidity, and I think that would be a good place for investors. So I think if someone's launching a game and there is a token, but I think that's got to be far more attractive than a game that doesn't have a token associated with it.
But then it's a security. Yeah. Then it's a security. Like it's quite clearly a security. And look, I'm not naming any names, but they're investors, at least 2 or 3 years ago, were buying both equity in price rounds. They were buying the equity traditionally, and that's, of course, it is a security. And then they were getting tokens as well, right? And I don't know. I don't know what that means. Again, I'm not. But that to me looks very much like double dipping. It looks very much like, hey, if we can't make our money, this is literally what you just described, Steve. Like, if I can't make my money on the priced equity, on the preferred stock in this company, because it takes a long time to get to liquidity, hey, maybe I can get a little double dip here, you know, with the token if it goes up in price, right? So expectation of profit. So that to me is a clear case of it being a security. Whereas NFTs, in my mind, like they're not, right? So anyway, I'm going to push back on that a little bit. Like, yeah, so investors, if they are investing into tokens,
for it, I'm agreeing with you.
Oh, you're agreeing with me. Okay, all right.
I think that's, so the question is, will investors pull back from NFTs or tokens?
Yeah, and to me, the answer is obvious. Like, they will. Yeah. Like, I mean, they are risk takers, but if there is a SEC ruling out there, like, it was just wait, especially given the returns in Web3 have been minuscule. Like, I don't know, has anybody made any money?
If we were in a bull run, they would still do it because the due diligence is like zero in a bull run. So it's only because it's pulled back that they would actually be like, maybe not.
Yeah. Yeah. So this is just my opinion. My opinion is like investors are not, I mean, some investors are stupid, but investors are generally not stupid, right? And generally not stupid. And if there is legal risk involved, like their diligence teams especially if they're the top tier investors, they're not going to touch this with a barge pole anymore because it's just way too risky, right? Now, maybe the Wells notice, once we see what's actually in there, if we ever get to see what's in there, it may be a settlement. It likely will be a settlement by OpenSea, and we won't necessarily know exactly what was there. So that'll be a shame because it would be nice to shine some light on this a little bit and understand what exactly the issue was, and like were they specific projects like Devin seems to think, or whether it was a more broad brush like the other Devin Dinser seems to imply in his posts. But until such a time that there's clarity, that's one thing investors don't like. They don't like uncertainty. They don't like to have a situation where there's no clarity around like, okay, what is this even a viable thing? Are we going to be breaking the law, or are portfolio companies be all breaking the law down the line? I think this is going to have a pretty chilling effect. I invited a VC onto the Web3 VC onto this pod, but we didn't manage to get it together in time because it was
very quick. It was an emergency. Yeah,
emergency pod, man. That's what emergency pods are all about. You got to do it quickly. Or that's what I think anyway. It's the first one I've done. So
happy to be here, Niko.
Yeah.
That's right.
So yeah, Devin, your thoughts. What do you think? Like investment in Web3 has not had great returns. This is going to make it better or worse?
I've had to deal with a lot of interacting with VCs. I have friends that are VCs. I have a lot of projects either pre-funding or post-funding. And the thing is, they don't want to touch NFTs anyways. So this is like so irrelevant to them because they care about tokens. And honestly, tokens don't make sense for like 99% of games. Tokens are for investors. It's a way that they can fleece the customers for their money back instead of the business. And to Steve's point, then the business doesn't make any money because now they're competing with their investors just to keep the lights on. Well, the investors over there are like, hey, don't go into that business. Come over here into this alley and buy this from me instead. Like, it's like they're selling the business's stuff off on the side. Like, no. You don't want to buy from them. No, just buy from me. I bought from them already, and I'm selling it to you now. Don't worry. And that's such a problem. And it's like, I've pitched so many designs around NFTs and stuff like that, and it's just like, no. Maybe the N in NFTs just stands for no freaking traction to them or something, but they're just not interested. And what's funny is at the end of the day, they're still doing the same thing, right? If they're just selling it to other people, it doesn't matter. But to them, it's not money. And I think that's a good thing for games when it comes to NFTs. If we want to stay away from the SEC, if we don't treat them like money and the investors don't treat them like money and we treat them like things, we're going to get a lot better, like away from the SEC. And then investors can be like, hey, I want to invest in the game company. And they have secondary sales. And I can maybe somehow as an investor in the company recoup from royalty fees. That's all totally reasonable. And I don't think the SEC comes in there in that sense, especially if it's like one of the things I want to mention earlier, to what Steve was saying was most game companies aren't going like, hey, you could take your items in this game and you can continually flip them for profit forever. Usually the pitch is when you're done with this item, you can sell it for less than you paid for it and get some of your money back, right? It's more GameStop than it is Sotheby's. Right.
Ooh,
and
yeah.
at the end of the day, they're just like, no one's GameStop's not out there pitching like, or EA, like you buy this Madden and don't worry, you'll be able to sell it for twice the price next year. Like Ultimate Team somehow makes this FIFA like, or FC, like, even though it's old, it goes up in price. I mean, you could have made the, I guess, argument for maybe Japanese imports, but no one's pitching it like that. That's like got any sense in games. And I think that's why I feel like games are okay if they're being honest with themselves and they're not just being like, how can we get money right now? And not just kind of looking for some opportunity to get funding in a really tough environment. And I don't blame them. I'm happy to help them try and figure that out and navigate that because I know you want to make a game and it's expensive and it's risky and like, you're like, who's going to take that risk for me? So that's great, but it's also very, very difficult right now. And I don't think tokens are the smartest way to go about it. Obviously, like a lot of these VCs have tokens as their mandate for the liquidity. And I know that's changing occasionally over time and stuff like that, but some of them it's just like, dude, this has got to go into tokens and it's probably got to go into something that's not going to pass SEC muster. And I know I see a lot of them tiptoeing up to essentially revenue share models or gambling models because those are other models that make sense financially, but also dip into different areas of regulation. And I think that's the problem is any area that's really going to be profitable outside of typical game stuff is most likely going to dip into something else, except for, I would say, royalties. And if you look at Valve, they've essentially done that just fine. Yes, technically they're not getting royalties, but they're the only ones collecting a market transaction fee, and the majority of transactions are for their items. So, they basically are. We'll see what Deadlock does when that comes out here, but I do think like they've shown that that's fine. And I think that is fine. I think if you're just like, hey, you could transact in the secondary market, but you just got to give us a little cut because like you're cannibalizing a primary sale, that's fine. Like everyone's okay with that as long as you're not committing fraud. Stick to that. You'll make some money off of that. Just do it smartly and you're okay. Like let's stop trying to do weird hoops, sneak in through the back door and then go, oh, we're caught. Like that's not a smart way to defend this. If we're not self-policing, guess who is going to? We're going to have Gensler at your door and like, we don't want it. We don't want to invite him over by not self-policing. It's like any industry that doesn't self-police or self-regulate ends up in that situation. And the only way we can get out of it is if we self-regulate it.
Yeah, and I mean that was that same argument for crypto. Like, oh, don't regulate us. Like we're self-policing. Well, how did that go? Didn't go very well.
But there was so much financial motivation for shady behavior. Everyone was like behind closed doors, like it's fine, dude. Just don't let Gensler see. Yeah. And it was like we kind of deserved it, to be honest. Like that's why some people cheer the regulation when it happens or when SEC goes after someone. This is like, well, don't do that then, and that's helpful. So
yeah, Steve, we're coming up to time here. So final thoughts from both of you. Why don't we start with you, Steve? And I have one final question at the very end once you've given us.
Final question. It's like the last question in Jeopardy. I want to save my points to wager. I don't think it's going to be detrimental to gaming. I think to Devin's point, if we were in a bull market, people would be investing. They're not investing, not so much because of this, it's just because NFTs have crashed significantly in the last couple of years. I don't think they're ever going to come back to the where they were in 2020, 2021. Investors, in particular, though, I think they do, and maybe I'll disagree with people. I think they, they're here for the risk. Now, most investors, they don't get in trouble for investing in mid companies. So what you have is like really good companies and really bad companies kind of get cut on the floor. But I think they are looking to risky investments, and they want to figure out, how could a company, push so far. And what would help is things like this, and either action letters, no action letters, lawsuit, just trying to figure out what's the regulatory ways to advance in this technology. I think there's going to be a future. I don't think it's dead yet.
Yeah, I mean they're looking to make risky investments for sure, but not risky investments where there's legal risk, right? Like it's more about business risk, market risk. That's the risk they're taking. Team risk, like that's the risk they're taking. They're not taking legal risk. And so to me, this seems like there's more legal risk because I don't know. If you guys
it's another way to say no, right? Yeah. And investors are always looking for ways to say no.
Of course.
And
which,
so if you
to
go
me
down
is a chilling effect. But okay, let's see. You're optimistic on gaming. Devin, your final thoughts?
Yeah, I mean, I definitely think it's a chilling effect on a particular type of investment. But I think at the end of the day, like the important thing is like, and then this is always like the first question I ask people when I'm starting to work with them is like, what's your business model? If you don't know what that is and it's just speculation, then you're probably going to get in trouble with some industry, whether that be gambling, whether that be securities, whatever it is. If you can't actually clearly articulate your business model or don't really know what it is yet, you probably should like think about that. And I think that's like an important lesson here is like, if your business model makes sense and it's not just trying to set up this Howey test kind of stuff, like then it's probably fine as long as it doesn't violate some other thing. And I think, yeah, maybe the SEC hasn't set up like, color in these lines specifically. But I don't think the Howey test is that hard to understand, especially when it's so fragrantly in the marketing sort of gone around. And I think if you could say, like, there's clear utility for what I'm doing, you're actually buying something of value or getting something of value that could have future value because of ideally your contribution and not the contribution of a common enterprise or whatever, you can steer away from the Howey test. I think it's not that hard to be like, iceberg ahead, you're not on the Titanic. I think you could pivot a little bit first and see this coming, but it will definitely have a chilling effect on investment to some extent. But I think we were kind of already getting there anyways, and I think we were kind of on sort of the last legs for some of that, maybe from venture capital. Investing in games right now, I'll be honest, is not the greatest business, and it never was a great business. It could be an interesting business, but it was never great. And I think now, like the Web3 angles, like I think there's absolutely opportunity for new business models, new ideas. I'm always exploring that space. There's always really cool things you could do. Secondary markets are a really cool thing. These are all great things. Continue to explore them, but just let's stay away from the Howey test. so we could just focus on games.
So,
all right.
I like that because
Go ahead.
FIFA, just one comment. So it seems, maybe it's two to one here, but it seems like arguably we are leaning towards a gray market, that NFTs, could be closer to securities than purely goods in some of these cases for OpenSea or Meshing. But I think, what we are agreeing also is like the NFTs themselves are unique, right? They represent digital art collectibles, other assets for games, and that perhaps the way that we look at, the Howey test or the way we look at securities, probably doesn't consider the innovation that is NFTs and the things that we're moving towards, right? So I think when we start this call, I think the Howey test you said was 1930 something. Kind of hard to, I think apply that to what the future is coming with NFTs.
Also kind of hard to say you don't know about it when it's that old.
Yeah.
Sure. 90 years old this year, huh? 1934. So if my math is right. So yeah, coming up to a century old. Okay,
he's doing it for the birthday anniversary.
Yeah, there you go. He's getting ready for
Could we do the Wells notice as an NFT? Should we do that after this?
There you go. That's what we should absolutely do. So fun. So final question, fun question, hopefully. So former President Donald Trump has just issued his 4th NFT collection on Tuesday, literally, of this week. Today is Thursday, August 29th. This is the day after August 28th, which is when the Wells notice, or when the OpenSea news broke. So he's doing his 4th NFT collection. It is a collection of Donald Trump in much younger, more vigorous, superhero, thinner mode. They are, there's one of them, at least, where he's holding a Bitcoin. He claims, he says, Trump digital trading cards, NFTs, are intended as collectible items for individual enjoyment only, not for investment vehicles. So, question, Howey test, passes it or not?
Oh, like it's a simple yes or no?
Yeah, he said it. He said it does. He said it does. He's like, it does.
Yeah, he said it.
It's not an investment vehicle. Coins, right? You see those like commercials for collector coins that are like pseudo infomercials during the day, where it's like for these collector mint coins, whatever, Liberty coins, whatever it is. Same kind of idea, right? But Trump said specifically he's going to get rid of Gensler if he gets elected, so he's defending himself. Because I believe, if my understanding was, Gensler was a Biden appointee, and you can't like fire the commissioner, but you could replace them by like nominee or chairman. So I think he technically can. So I don't know. I guess he could always protect his own trading cards from the Oval Office if he gets in there.
There you go. All right. So you're like, yep, he said it wasn't, so it isn't. There you go. Steve, is it as simple as that? If I go out there and say, hey, no, this is not an investment vehicle. This is for individual enjoyment only. We could just do that, and then we're good to go, right?
I think that you're good to go. I mean, there's cultural significances with some of these NFTs or, rare double eagle collectors mints coins, right, being sold now. Right. I think there, you have to look into that.
So what I hear you saying is
the challenge is to balance forward, right?
You're all in on Trump digital trading cards.
I'll take one if he wants to give me one.
Yeah. All right, they're $99 each, guys. So
okay, never mind.
Here we are.
Well, hey, it's a fixed fee. That's great.
Yeah,
that's
there you go. And there's no.
How much can I sell it for later?
No expectation of profit. It's for individual enjoyment
only. The expectation of profits if he gets elected, right? So you're just like, all right, I'm making a bet on the election.
There you go. Yeah. Well, I may as well go to the bookies for that then. Okay. On that note, then, so everybody agrees, Donald Trump digital trading cards, NFTs, are indeed collectible items, and they're individual enjoyment only. They are not for investment purposes.
Clear utility.
Yeah. Okay. That's clear then. Excellent. All right. Well, gentlemen, this has been an excellent time for me, at least. Hopefully also for our listeners. Very interesting. I see and appreciate that we had some differing opinions on certain things, and that's always good. It'll be interesting to see what's in that Wells notice if we ever get to see it. Some clarity on this would be so good. I think that's the one thing that would bring investment back. If there's clarity on what is okay and what isn't okay, that's the one thing that I think a lot of us developers too would very much want. The crypto purists, not so much. They don't want any regulation. They don't want any clarity. They just want stay out of this. Okay. Well, Steve, thank you very much for coming.
Happy to be here. Thanks.
Devin, thank you again for taking the time and doing this last minute.
Always, Niko.
Excellent. All right. And also a big thank you to all of our listeners. Welcome back. This was an emergency pod. Hope you enjoyed our very first Naavik Gaming emergency podcast covering the OpenSea NFT stuff for lack of a better word. A lot of stuff we covered today. So on that note, then come back next week. We'll have more interviews, more insights, more analysis from the weird and wonderful world of gaming.
If you enjoyed today's episode, whether on YouTube or your favorite podcast app, make sure to like, subscribe, comment, or give a 5-star review. And if you want to reach out or provide feedback, shoot us a note at podcast@naavik.co or find us on Twitter and LinkedIn. Plus, if you want to learn more about what Naavik has to offer, make sure to check out our website, www.naavik.co. There, you can sign up for the #1 games industry newsletter, Naavik Digest, or contact us to learn about our wide-ranging consulting and advisory services. Again, that is www.naavik.co. Thanks for listening, and we'll catch you in the next episode.